and this is one of the lessons I've learned as an advisor, right? People will say, oh, I'm an aggressive investor. And I go, tell me more about that. What does that really mean
What
to
does
you?
that mean?
You
What does
know,
that really
and they say, well, I told my last guy, I want aggressive, you know, and I go, okay. And I look at it and I'm like, well, you still have, you still have 15% allocation to some bonds, and you know what I mean? And you have, a spread of index funds, and you have stuff in here that's value tilted, right? Like there's different components that would be de-risking from what I would say is really aggressive, right? If somebody comes to me and they say, well, I'm a really aggressive investor, and then they whip out and they have a whole portfolio of, let's call it digital assets, right? Not to name any specifically here, but it's like, you know that there's a lot of volatility in that asset class, and they go, yep, I've never sold, I've always, hey, I can withstand something to zero. I'm happy to, if I lose all of it, it's good. Like that. Well, that is aggressive investing. That's really aggressive, right? When you talk about something, taking significant drawdown, significant losses, and you're not changing your behavioral decisions, right? You're not letting behavior drive the bus at that point, then okay, you're aggressive. But most people, when you start talking about in terms of actual losses, so you have $100,000 here. If you get a statement, that's $70,000. How does that make you feel? Like, do you want, well, yeah, I might want to do something different. Okay. You're not as aggressive as you thought then. So we need to have a plan to manage the risk, right? And that's where, you're saying tactical management helps. That's your opinion or analysis of it, because you're helping somebody navigate the market timing a little bit, so that they can stay invested for a longer period of time. And we know if we stay invested longer, we have a better chance at a better return over time, right? Like in a general sense.
And in some ways, you're kind of managing, client psychology, because inherently, I believe most clients are trend followers. Okay. They'll look at what happened over the last 6 to 12 months. They'll draw a straight line, believe that will continue to be what happened. So they tend to get out of the market a little bit too late after the market's already down. And they tend to get back in a little too late again after the market's already rebounded quite a bit.
Mm-hmm.
And that's really one of the reasons why I like working with cycles so much.
Yeah.
Because, a trend is your friend until it bends or until it ends. And cycles will tell you in advance when that trend will bend and when it will end. So by using cycle theory, I'm able to prepare for orderly entrances to and exits out of the market.
Yeah. So it's kind of giving you, there's the old analogy about, everyone's watching a movie in the movie theater and it's great. Everyone's enjoying the movie, but when there's the fire, everyone rushes to the door, and everyone can't get out fast enough, right?
It's messy. And as an advisor, handling that many trades at once is really hard.
Yes. Well, and most people technologically just aren't set up for the way that, we are to manage. And I do have a deeper theory about large institutions in general and the notion around index fund passive buy and hold investing. Because if you manage trillions of dollars, you can't support people moving in and out of the market all the time.
Well, that's right. Yeah. So I mean, there are a lot of different ways of doing risk management, right? From diversification to managing your position sizes, to using trailing stops, doing tactical allocation, using, stock options. And out of all of those different risk management techniques, 2 of them are really easy to implement and monitor, right? Diversification and position sizing.
Yeah.
The other 5 take a lot of work, which is why people don't do them, but it's exactly why you should consider working with an active manager that does.
Yeah. So, talk to us a little bit. Teach me a little bit more about cycles, right? And maybe some of the more well-known cycles that people should be aware of, and sort of how those kind of line up, and what to expect as those cycles progress and flow through markets and economies. And
Yeah, and some of them are really important. And as you know, I've spent a lot of time studying the markets. I've been in the business for 30 years, and I've always wanted to try to figure out what happens next. And I really settled upon cycles, seasonality, and calendrical effects as things that you can reasonably predict. I've tried using standard technical indicators. I've tried using economic indicators. I've tried, traditional valuation metrics. But what I've really settled upon are these ideas of repeating calendrical and cyclical patterns. So what I've done is I've built a few systems for timing the market, or practical allocation, as it's called in light circles. And I've used machine learning, which is a type of artificial intelligence, to help me figure out which signals I should pay attention to and which ones I should ignore. And I'm going to share with you really the biggest signal that I use. If you can put me into screen share mode, if I can do that.
Yeah, Mal, if you can just enable screen share for him.
Yeah. So let's pull this up. So this is, I think, the most important cycle that absolutely everyone should know, but nobody talks about. Okay. And this is based on research from a group called the Foundation for the Studies of Cycles.
Very well known group. Most people know that group.
Oh, they do.
Yeah.
Cool.
Yeah.
We're hanging with the right crowd then. These are good people. So we have the S&P 500 index in the dark blue line. We have the 181 week cycle in purple. Okay. And what I've done here is I have gone in, I've tested every weekly cycle going from 3 weeks in duration out to 400 weeks in duration. I've gone through the full spectrum of cycles.
Okay.
And I've tested those cycles for two things. One is for fit, and that is, do they turn at the same time that the market turns? And that's, demarked by the triangle size here. Okay. And then the second is magnitude. And that is this a strong cycle or is it a weak cycle? On a per bar per day basis. And when we run through the full spectrum of cycles, you'll see that one really stands out here, which is this 181 week cycle. That's about 3.5 years, by the way. And I've tested this going back about 2 decades, is the optimization period for this. And if you look at that, this is how the cycle overlays on the market. Now you're going to see something sort of interesting if you really look closely at this. The cycles aren't perfect up and downs. It's not a sine wave. It's more of a sawtooth. And that's because markets spend most of their time going up and only a fraction of their time going down. Mm-hmm. Historically, markets are going up about 60 to 65% of the time. They go down about 30 to 35%, something like that. So this cycle really, really nailed the top of the market in January of 2022. I wish I knew about it then. Okay, I didn't know about it then. Things went to hell in a handbasket for it. Like promptly, S&P was down 30% in a year. Things got messy very quickly. When I started getting into this was really right around here. Okay. And I last ran this cycle study in May of last year. And it told me just go in with both feet. Okay. It said, this is looking really, really good for a long time.
That's fun. I remember being with you, talking to you in Scottsdale last May, early May. And you said, hey, we'll see what the second year that the second half of this year looks like. You told me the trade calendar, we are going to spend a lot of time in the market. I remember you telling me that.
Yeah.
early last May. Anyways.
And it was a fabulous year. And this year is turning out even better, for the types of things that I do.